Hi, this week we're going to talk about current liabilities and contingencies. Doing something a wee bit different this week. I'm using a new program I have, so this is going to be on a YouTube. Be sure to let me know which way you like it best, with the Pincast or the YouTube. So this week we're going to look at the conceptual overview of a liability. First we're going to define it. We're going to look at the characteristics. We're going to define the classifying current liabilities. We're going to look at each area, contractual, depends on the operations and the amount to be estimated for a current liability. And finally, we're going to look at contingencies. So let's go back to the top and start with what is the definition of a liability. And this definition is for both a long-term and a short-term liability. The definition is a probable future obligation that's going to require an asset sacrifice, usually in a monetary asset. The second definition is it's usually bound by a promise of contract. That contract can be legal or it can be non-legal. And by this we mean it can be accounts payable, something that is legal and binding, or it could be something like a compensated absence, which is a non-legal. There's no um, formal legal right to that. So we'll look at those two. Then the characteristics of a liability involve responsibility to settle it with a future asset. The obligation cannot be avoided, and usually the obligation has already occurred. The obligation does need to have a payee for it to be ID'd, and it doesn't really need to be legally enforceable. It is liability. So that is the overall view of a long-term and current liability. If we really want to look at a current liability, then we're looking at the liability is due within 1 year or within the operating cycle of the business. And that could be more than a year depending on the project and how it's set up. The classifications you're going to find on page 603. There's a really good box or identify, I think it's called an exhibit, that breaks these down. So your classifications are contractual, and an example of contractual is going to be accounts payable, note payable, current portion of a long-term note, dividends, accrued liabilities, or an unearned liability. The other ones, there's two others. There's depends on the operation. This is a liability that's contingent on what you do in your business, such as sales tax. You can have a low sales tax, or you can have a really busy year and have a very high sales tax. So this liability will go up and down with operations. Payroll tax and income taxes in there, bonuses also. The final one are the liabilities that usually must be estimated. Property taxes and warranties, premiums and coupons. There's these two in particular have very complex uh, accounting to them for no more or for as little attention as we give them in the lay world. There is quite a bit of accounting behind the warranties and the premiums. And other contingencies flows under this amount that must be estimated, which takes us to our next topic, contingencies right here. And a contingency is an existing situation involving uncertainty that may result in a gain or a loss at a future date. And that's a very short version of a contingency. Contingencies are usually of the legal nature. There could be a lawsuit. It could be a pending patent that that you're trying to extend, and you can't get it extended. There's no certainty. It could be a drug trial that's going on, that there's a lot weighing on. So there's a lot of things that can be contingencies. there's some terminology used with this. One, there are three, and these are kind of important because that how these are used or how these apply to the contingency will depend on whether things are disclosed in the financial statement. And if you look at pages 623, 625, and 627, you can see how these words interplay with that. The other things that you're going to look at is a loss or a gain and when to record it. So let's come back and look at probability. If a contingency is probable, that means it's likely to occur, and you're probably going to have to, if it's a loss, record it in the financial statements and definitely disclose it. If it is a reasonably possible, it's more remote than likely, and it may just need a mention in the financial statements. If it's remote or slight, depending on, I would say, the amount, um, you normally are not going to have to do anything with anything that's remote or slight. So if it comes down to, and you have a loss, or you think you're going to have a loss, or there's a high probability you're going to have a loss, you're going to record it on the books as long as it's reasonably estimated, or you can estimate it, a value to it. Otherwise, it's going to be mentioned in the disclosures strongly. A gain will only be recognized when it is realized. So that the gain has a lot less importance in this case, I guess, as far as disclosures. You always want to make sure that you show the disclosures. Now, there is a lot in this chapter. We really basically are going to look at two problems. One is payroll tax, and the other one is property tax. So as you read through the chapter, make sure you pay close attention and mark those papers. I will probably do a pin cast on both of these so that you can see how to set up the activities. Thank you. Have a good time with this chapter. It's good.